Okay, it's now my pleasure to introduce Jeremy Stein, President of the American Finance Association. Rather than reviewing Jeremy's work, there's something of a tradition in introducing the presidential address to loosen up the presenter, Jeremy in this case, with a bit of a warm roasting. And he certainly did a good job of this last year with Ken French, and I'm sure he's at least a little bit worried about what I might say this year. As everybody knows, Jeremy is one of the most highly regarded and admired financial economists of his generation. His influence on research is very deep and well known. You just heard a bit about that from Harrison. So I figured I'd need a bit of an edge to find something interesting to say about Jeremy. So I called his dad, Elias Stein. Eli Stein, as many of you may know, is a world-renowned mathematician at Princeton. He's the real deal, National Medal of Science, Wolf Prize, it goes on and on. He and Jeremy actually wrote a great paper on option pricing theory. So I figured maybe that there might be some anecdote that would come out of that that I could use, or maybe something a bit earlier in Jeremy's career. Well, right away, Eli said something like, "You might be surprised to hear that when Jeremy was a student, he was not really that driven." I said, "Jeremy?" "Oh, yes," said Eli. "He was quite laid back. For example, when he was an undergrad, he decided to take a year off from college and go to San Diego and do some hang gliding." And then I was kind of amused the way that Eli said, "Not that Jeremy could hang glide." Then Jeremy thought maybe he'd take some time off and sell encyclopedias, or maybe be a plumber. And I'm not making this up. But Jeremy did go back and finish college. Then he apparently got interested in finance after spending some time working at a bank. Eli reported that Jeremy sent home the news that he thought he had an edge at the bank and in finance because nobody else at the bank could understand how to discount cash flows using geometric series. Oh, yes, said Eli. Jeremy was very relaxed. A month or two after he started his PhD at MIT, Jeremy called home and said maybe he'd quit and go to Hawaii and take up surfing instead. Then Eli said, "Not that Jeremy could surf." Anyway, after a few phone calls with his parents, Jeremy decided to stick it out at MIT. Toward the end of our call, Eli said something like, "I suppose Jeremy will figure out this came from me." Yes. Well, here he is, Jeremy Stein, to give the presidential address of the American Finance Association.
Well, thanks very much. Thanks, Daryl. That was fantastic, and a little bit of it was actually true. My dad is kind of old, and the memory is one of the first things to go. But anyways, thanks very much, and thank you all for coming. It's really, I mean, I have a lot of friends out here, and it's great for you all to be here. And my wife and my son are here, which is a real treat for me. So, one last thank you. I'd like to thank Sam Hansen, who's a graduate student at Harvard, who gave me quite a bit of help with this project. Okay, so let me get started. So basically, this paper is first and foremost, it's testament to the difficulty of market timing. So I started on this project last February, maybe, or this 11 months ago, and I really wanted to do something timely. So at the time, I was thinking, what can I do that's sort of big in financial markets? And I don't know if any of you remember the quant crisis of August '07. It sort of was a big deal back then. Now it's a kind of a molehill among the many mountains of our ruined financial landscape. But at the time, that was kind of interesting to me. And you'll see, I mean, this paper is not exactly about the quant crisis, but you'll see that was clearly kind of the motivation behind it. And so I'm only about 12 months behind the times, but I'll do the best. I'll do the best with this that I can. Okay. And you'll see that some of the stuff about the quant crisis, I think, has something to say about the more recent financial turmoil, and I'll try and emphasize those parts of the paper as best I can. Okay. So let me start by telling you something you all know, which is the enormous growth in or rise of sophisticated investors. And there are many ways to say this. A common metric, if you will, is to look at the enormous growth of hedge funds. So, okay, so I have some numbers up there from something like $40 billion a little over a decade ago to about $2 trillion as of a few months ago. Okay? And what do I mean when I say they're sophisticated investors? You can take that a bunch of different ways. For the purposes of this paper, I have in mind two particular attributes. The first of those being the methods they use to generate alpha to sort stocks. And here I'm thinking about the many, not all, of course, but the many funds that use kind of research that all of us are familiar with, that look at quantitative screens based on, value growth, momentum, post-earnings drift, accruals, et cetera, et cetera, et cetera. But I have in mind sophistication in the use of quantitative methods to pick assets. Okay? The other dimension of sophistication that I'm thinking of is the use of substantial leverage. Okay? So those are sort of the ideas I'd like to fix in your mind. Now, of course, the hedge funds, even though they're $2 trillion, are really a small part of a much larger trend. And for those of you who were here last year for Ken's address, this is another one of the things that was really in the back of my mind when I started this project was, if you'll remember his address, the kind of indelible image I have is basically the point is the world now seems to be one in which most trading seems to take place between sophisticated institutions as opposed to between individuals and institutions. And so for those of us in the kind of behavioral finance tradition who are used to thinking in terms of classic noise trader models with smart and dumb, and we often lapse into thinking of the individuals as the dumb, where have all our dumb guys gone? So in this world, it's as if we've kind of converged to a world of smart people. Okay? And that's kind of the launching point for what I would like to talk about. Okay? And so the very, very simple question is, if you take it, I'm going to ask a conceptual question. There's no data. But if you take it kind of as given that we're moving to a world where a larger fraction of the money is controlled by smart investors, will this make the world a better place? By better, I mean, will prices on average be closer to fundamental values? Will there be less non-fundamental volatility? Okay? So now, if your operating model, if you're, again, a sort of standard behavioral person and your operating model is smart versus dumb, the comparative static would seem pretty obvious that if you have more smart guys, prices are going to be more efficient. Okay? Now, it certainly must be true. It certainly must be true, and I'm not going to take any issue with this point, that if you have a given anomaly, so think of this as the January effect or post-earnings announcement drift. If you have a given anomaly and more smart people trade against that anomaly, in the limit, as the amount of risk tolerance devoted to trading against that anomaly gets large, it must be that the profits disappear. Okay? That's not deep. That's not even finance. That's just a zero profit condition. Okay? So that's a given. And I don't want to argue with that. What I do want to ask is the corollary of that zero profit condition increased efficiency? Okay? Or is there potentially any slippage between profits going to zero as a result of the sophisticated investors and efficiency going in one direction or another? So, in principle, what can go wrong here, the extent to which these two may not line up with one another, the extent to which the zero profit condition need not, as a matter of theory, imply greater efficiency, is the extent to which arbitrageurs inflict externalities on one another. Okay? So if arbitrageur A, in the process of pursuing profit opportunities, somehow screws life up for arbitrageur B, maybe something can go wrong. Okay? That's sort of a general principle. That principle is not new to me, and I think it's sort of understood at an abstract level. Okay? But what I want to do is focus on two particular mechanisms by which these externalities are inflicted. Okay? The first of these is what I'm going to call a crowded trade effect. Okay? And you're going to start seeing where the motivation from the quant crisis, where the motivation comes from. So what I mean by a crowded trade effect, it's a situation where each individual arbitrageur has uncertainty about how many others are doing the same thing that he or she is doing. Okay? And that can make life a little bit difficult. So that's going to be sort of externality number one. Externality number two is going to run through leverage and a fire sales effect. Okay, this is, again, pretty familiar, I think. It's the idea that, if arbitrageur A pursues a strategy with high leverage, if he gets into trouble and has to start unwinding positions, his sales may knock down the price of an asset that's also held by leveraged arbitrageur B and force that arbitrageur to unwind and so on. Okay? So there may be an externality ex post as they unwind, and there may also be an externality ex ante in the choice of the initial capital structure. Okay, so those are the two effects I'd like to highlight. In doing that, I want to kind of emphasize that I'm going to try and make arbitrageurs as rational as possible, and I'm going to allow them to make optimizing leverage decisions. So the first point applies in the crowding situation. In other words, an easy thing to say would be, well, if I thought there was nobody else playing the strategy, and in fact there was, obviously something can go wrong. Okay? That's sort of cheap. I want to sort of make a little bit more subtle point, which is even if people make the best possible unbiased estimate, but have imperfect information about how many others are in the market, you can get fairly substantial problems nevertheless. So people, there's crowding. Everybody understands crowding is an issue. They'll never be perfect. They try to learn as best they can how many others are active in the market. And even if they do that in a rational fashion, I'm going to argue that there's still problems. Okay? The other place this comes in the leverage thing is I'm allowing people, many of the fire sales models effectively start from the premise, well, arbitrageurs are highly levered. Let's see what happens ex post. I want to kind of back up and say, wait a second. If it's such a bad thing to be a leveraged arbitrageur, if you're going to get so killed in a fire sale, might you not want to adjust your capital structure? Maybe you get burned once, but after having been burned, maybe you'll sort of figure it out and you'll play with a little bit less leverage. Okay? And again, I'm going to make the point that even if you give these guys access to a perfectly elastic supply of long-term equity finance and allow them to choose whether to be debt or equity financed, you're still going to get these problems in equilibrium. Okay? So again, I'm trying to think of this as a steady state, rational setting, at least on behalf, on the part of the arbitrageurs. Okay? Why is this relevant? Well, think back to the quant crisis. Okay? Again, what was the kind of key feature of the quant crisis? There seemed to be a lot of people playing the same strategies. They were all playing the market to book or the momentum effect. They were all doing so with high leverage. When a shock hit the system, everybody started unwinding the same positions, and we got these enormous non-fundamental movements in prices, on the order of 10, 20 standard deviations relative to historical norms. Now, on the one hand, the postmortem here seems to be pretty clear. Everybody says, well, there were too many guys doing the same thing, and they were too levered. Okay? But a question that arises then in that postmortem is, should we think of this as a self-correcting one-time mistake? Like this one, it may be that just, look, we underestimated how much inflow there's been, but now that we have kind of a good idea, we'll adjust, everybody will pull back a little bit, everybody will readjust their capital structure, and things will take care of themselves. Okay? That would be kind of an optimistic spin. By focusing on kind of this long-run equilibrium, I want to make the argument that, well, of course, learning is likely to be helpful. It's not likely to solve everything. That there are problems that kind of remain in equilibrium. Okay? And obviously, I'm not going to have really precise things to say about policy, but if you wanted to start having something to say about policy, the things that don't get fixed by the actions of the actors themselves, I think that's the sort of beginning point of the argument. Okay, so that's sort of the game plan. Now, the paper itself is a little long-winded. Okay, I was unable. The elegant thing obviously would have been to put these two effects together in one model. Couldn't do it. Okay, so the paper has two models. It has a model of the crowded trade phenomenon, and it has a model of this leverage effect. And what I'm going to do, I don't want to death march you guys through all this. I'm going to say, 5 minutes worth of stuff about. I'll give you kind of an abstract of the crowded trade model, and I'll put it up on my website, and you can have a look at it if you want. And I will focus on the leverage and fire sales model. In part because while I've set this in kind of a hedge fund arbitrage setting, I think here the basic structure feels a lot more like it's relevant to the banking crisis more generally, and there's kind of a little bit of a policy angle, which again I think might be at some level useful for thinking about that stuff. Okay, so again, I'm going to focus on Model 2. I'll try at the very end to tease out some of the implications for capital regulation, and I'll now just give you a couple of minutes on the first model. Okay, so first model, crowded trades. All I want to do is kind of tell you the ingredients that go in. I won't show you anything that really comes out. Okay? So and this shouldn't be too surprising for you. If you want to think about this crowding phenomenon, there's kind of two key ingredients. Okay? Ingredient number one is that each individual arbitrageur, when he goes to trade something, is not sure how many others are going to be doing the same thing. So if you want to think about this algebraically, think that the number of arbitrageurs entering a trade at any particular point in time is equal to n times theta. N is the expected number. It's sort of your best expectation of how many are going to be there. And theta is a random variable with a mean of 1. Okay? So when theta just is 1, the number who come in are kind of like what you expected. When theta is higher than 1, the trade is overcrowded relative to your expectations, and conversely. Okay? So n here kind of scales the expected size of the arbitrage sector, and theta tells you about fluctuations. Okay? That's ingredient number one. Ingredient number two is we have to be talking about a trading strategy that has no fundamental anchor. Okay? What I mean by that is it's not a situation where the arbitrageur says, I know fundamental value and I know price, and my trade is going to have to do with the difference between them. Rather, it's a case where the arbitrageur says, I know some characteristic, some non-price-based characteristic that in historical data, and maybe for very good psychological or whatever other reasons, tends to forecast returns. So it might be something like buy stocks with low accruals, buy stocks in January, buy stocks that have recently had positive analyst revisions. Something like that, where you're not conditioning on price, you're just generating a list of stocks and buying them. In fact, in some cases, if you are conditioning on price, you're conditioning on it with a positive sign, momentum, buy stocks that have gone up. Okay? That's the second necessary ingredient. Okay? So the strategies that I've described are very, very familiar strategies. They're kind of commonplace in the real world, but I just want to point out they're different than the way we model arbitrage, where we kind of write down theoretical models. There, if you think of kind of the standard, again, noise trader format of DSSW, many others, we sort of imagine arbitrageur observes fundamental value, they observe price, they trade on the difference. That's not a model of things like analyst revisions. That's a model of something like, Siamese twin stocks. It's a spread trade. You see the size of the spread. There, uncertainty is not a problem. Why? Because the price mechanism mediates congestion. Right? In this setting, if a whole bunch of guys, way more than you thought, show up, no big deal. You observe the spread narrowing. You adjust your own demands accordingly. Everything works out fine. The market equilibrates because you're trading on price. Okay? On the other hand, if you're trading something blind with no anchor, you're just buying stocks that have recently gone up, or you're buying stocks because it seems to be the right month to buy stocks, or something like that. If a lot of other people show up and do the same thing, you have no price-based signal. Okay? That's obviously a necessary ingredient for this crowding phenomenon. Okay? So this model is kind of what happens to those sorts of strategies when there's uncertainty about the number of players. Okay? And I think that's descriptive of not all, but a pretty wide range of the kind of quant strategies that many of us are familiar with. Okay? And it turns out this can create problems, and it can actually create pretty severe problems, to the extent that you can be worse off in a world with extremely large but uncertain arbitrage capacity as compared to a world with only dumb guys and no arbitrage whatsoever. Okay? So again, if you think of my little expression where the number of arbitrageurs is n times theta, and n is the expected number who show up, if you let n go to infinity, you can come up with situations where that's no better or even worse in terms of the metric of prices being close to fundamentals than having no arbitrage whatsoever. Okay, again, I'm not going to try and demonstrate this to you, but the basic intuition here is now an increase in arbitrage capacity has two distinct effects. It has the usual good effect that you're familiar with. It's sort of an increase in risk tolerance which gets rid of inefficiencies. But you can also think of it as an endogenous form of noise trade. In other words, if I sprinkle an inefficiency out there and draw these guys in, they start arbitraging away the initial inefficiency, but they're also bringing this new form of noise, which is uncertainty about how many of them are going to be active. And it turns out all bets are off. The latter effect can be smaller than or bigger than the former effect, and in principle, prices can be no less close. Predictability, it's a little subtle. So if you start out with underreaction, and then you throw in a lot of this kind of arbitrage, there will be no more predictability in price. The underreaction will, on average, go away. But basically, it'll be now turned into a case where sometimes you have a lot of underreaction, sometimes you have a lot of overreaction, and the distance of price between price and fundamental value may be, again, greater or smaller. So that's that thing. Okay? And again, that's meant to only be an abstract of this idea. Okay. So what I'd like to do for the remainder of this talk is to focus on the second mechanism, which is leverage and fire sales. Now, let me be clear here about the nature of what I'm trying to add. I think the crowding issue is sort of a newer thing. It's gotten less research attention. This idea of leverage and fire sales is, of course, very, very familiar. Okay? You know, Schleifer and Vishny were among the first to make the point that if you have leveraged arbitrageurs and a shock hits, this can basically amplify rather than attenuate the shock. And then there have been a number of other papers that have sort of built on this observation. It's obvious. The first thing that people trot out now when they think about the quant crisis. Beyond that, in sort of less extreme settings, it's also been very helpful in thinking about, for example, the distribution of currency returns. So there's a paper, Marcus, Stefan Nagel, and Lasse Peterson have a paper about skewness in currencies, where they find that, you know, if you have a high interest rate currency and a low interest rate currency, it seems to be that the high interest rate currency is negatively skewed. Why is that? Because everybody's doing the carry trade. They're all doing it with leverage. And given that leverage, we can get kind of these rare occasional crashes. Okay? All that, I think, is well understood. Okay? What I'm trying to add to this is kind of the ex-ante dimension, which is most of these papers basically start by assuming leverage. Assume we have highly leveraged guys. Let's see what happens. What I'm asking is, well, geez, if this stuff is so problematic, and there's a lot of capital in the world, and presumably over time, as more money flows into the industry, wouldn't we expect that these guys would choose a capital structure that would tend to mitigate these problems? Because after all, you're kind of sorry if you have to fire sell your assets. You might have thought, geez, if I'd left a little bit of dry powder, hadn't been so leveraged, I could have bought at the time of the fire sale instead of having to unwind at the time of the fire sale. Right? So this seems like there's an economic incentive for somebody to have a capital structure that would stabilize this. Okay? So that's the question I want to ask, is to what extent or under what circumstances does this get fixed by people's optimizing capital structure decisions, or to what extent does that not help? Therefore, we're left with maybe a role for things like capital regulation. Okay? So, or said a little bit differently, is high leverage inevitable, or will it kind of sort itself out? Okay? Now, to do this, I've got to kind of have a little bit of a trade-off. So what I'm going to do is I'm going to assume that an arbitrage fund, think of this as a hedge fund or a bank, if you will, has you know, the choice of borrowing with short-term debt, financing itself with short-term debt, or getting stable long-run equity financing, and there's a little bit of a wedge. Okay? For some black box reason, I'll kind of come back to this later, for some black box reason, equity is a little bit more costly. Got a higher cost C. Maybe it's some kind of an agency problem. You know, you need to monitor the fund. You worry that people are going to, if you give them the money for a long period of time, they can mess up more. It's not as safe and secure as short-term debt. Okay? Now, in that world, how does an arbitrageur think about capital structure? Well, kind of like any firm thinks about capital structure. Debt is cheaper, but things can go wrong in the bad state of the world. Right? So what's the arbitrageur's basic calculation? Well, if I lever to the max and things go well, the trade converges smoothly, I'll be happy that I levered to the max. Okay? On the other hand, if something goes wrong, I'm going to be effectively bankrupt. I'm going to be forced to liquidate into a bad market. Then I'll wish I hadn't levered to the max. Okay? So that's the basic trade-off. The thing that makes it a little bit richer than the sort of standard capital structure question is that there's a two-way interaction between leverage decisions and prices. Right? So one way to just start giving you a little bit of intuition about this, imagine that C is small but positive. So equity is a little bit more expensive. That means in equilibrium, there's not going to be complete arbitrage. You know, guys have to cover their cost of equity finance, so there are going to be some small spreads left. Right? So whatever the trade is, you know, there's going to be a small spread left. Well, that small spread, you look at it and you say, that's a nice-looking spread. It would be nicer if I could lever that up. Right? That tempts you to lever. Now, of course, you think, well, but I could get hurt also levering. But now think about what's going on. can we sustain, one way to ask this is, can we sustain a situation where everybody stays unlevered? Okay? If everybody is unlevered in this world, they're financing themselves with equity, equity's costly, there's a small spread. So on the one hand, there's a temptation to lever up for the small spread. And you say, well, what's going to happen if I lever up and things go wrong? Well, if everybody else is unlevered, not all that much is going to go wrong, right? So you can see it may be very hard to sustain. So what I'm doing is sort of conjecturing an equilibrium where people are unlevered and then thinking about deviating. Does somebody want to deviate and lever up? And the answer is, if C is small but positive, quite possibly yes. They'll say to themselves, there's a bit of a spread. I want to do that more aggressively. You know, if nobody else is doing this, looks pretty good. Okay? So basically, what happens as a result of this kind of logic, and I'll try and make it more precise, is that the equilibrium leverage in this setting is very, very sensitive to small changes in C. So for very small C, everything may be fine. You make C just a little bit higher, all of a sudden the model's going to kick over into a situation where everybody wants to leverage up to the max. Okay? So that's basically what's going on in this setting. Okay? All right, so now let me put a little bit of structure. I'm going to do something which is probably stupid with an audience of this size, which is try to do just a tiny bit of math. Okay? Jason, are you paying attention? Okay. All right. So this slide is knocked off completely. I've just borrowed completely the market structure from Schleifer and Vishny's paper. And I'm kind of counting on the fact that many of you are familiar with this. This is very, very simple. Okay? So we get a stock that's going to pay a liquidating dividend at some time 3 of V. Okay? At time 1, there's an initial noise shock of delta 1, and there's some arbitrage response of A1. I'm going to endogenize A1. So it's just the dollars of arbitrage response and the dollars of noise shock are kind of duking it out, and the price is what results. Okay? It's essentially just the one offsetting the other. Okay? This is a very reduced form pricing function. This is sort of a Schleifer and Vishny-ism. And, you know, you've got in the background some downward sloping demand curve, which is giving you this. Okay? Nothing more to say about that. Okay? Then that's time 1. At time 2, one of two things can happen. Either the noise shock goes away and the price converges to fundamental value. And I'm going to assume that happens most of the time. So think of this as happening like 90 or 95% of the time. So that's a situation where you'd like to be levered. Okay? Alternatively, with some much smaller probability P, the noise shock might deepen. Okay? So the sentiment continues to move against you. Okay? What's going to be there? The price P2D is going to be, again, the noise shock offset by whatever the endogenous arbitrage response is at time 2. Okay? So this is the standard limits to arbitrage framework. Okay? What I'm going to add to it is give these people a richer menu of financing options than is in the Schleifer and Vishny model. Okay? So here's the deal. As I said, so there's going to be an infinite pool of arbs. They can either enter or not enter. Okay? Each one who enters can raise 1 unit of equity capital, and as I said, that equity capital is going to have a small cost of C, small unmodeled cost. Now, in fact, you don't even have to think of it as equity. What's really relevant here is its long-term financing. So it could be equity that it's non-demandable equity. It's like a closed-end fund or a bank. Or this could even be really long-term subordinated debt. Okay? So what's relevant here is it doesn't pull the plug on you at time 2. Okay? Alternatively, you can borrow at a 0 interest rate. Now, it's not a 0 coupon. It's a 0 expected return. Whatever expected return gets these guys, whatever coupon gets these guys a 0 rate of return. You can borrow at the 0 interest up to L minus $1. So think of L as a number like 10. That would be you can go to 10 to 1 leverage. So for each dollar of equity you put up, you can go to an overall trading position of 10. Okay? And they can choose any interior thing in there that they want, but this is short-term debt. Okay? So again, the cost of capital difference here that I'm assuming is that short-term financing is cheaper than long-term financing. Okay? And then what happens here is you can borrow short-term from time 1 to time 2. If the noise shock deepens and your wealth gets nuked, you can't borrow again at time 2. Now, that's unnecessarily restrictive. I could equally well allow you to reborrow short-term at time 2. It's without any real loss of generality because all the interesting action in this model is states of the world where your wealth goes to 0 at time 2. In the bad state, you're going to be completely wiped out. So whether you can lever or not lever, it's zero either way. Okay? So it just buys me a little bit of simplicity. Okay? So again, financing choices are, any leverage ratio up to L. Okay? So what are the possible strategies for these arbitrageurs? This is actually a lemma, so I'm going to rule out what are the things that they might actually optimally do. Well, one thing they might do is lever to the max. That can turn out to be optimal for, in a wide range of settings. Okay? And if you lever to the max and that max is a big number, it will turn out that in equilibrium, if things go against you, you'll lose all your money. Okay? You'll have no wealth and you'll exit the market. Okay? Just again, for the sake of simplicity, I'm going to focus on the region of the parameter space where L is big enough such that when you go to the max, you get wiped out. Okay? So one possibility, one strategy is go to the max, know that you're going to be wiped out if things go badly, know that you'll make as much as you possibly can if things go well. Okay? An alternative strategy is to be cautious. Okay? What I mean by cautious is you invest some amount I less than the maximum amount that you can invest, such that, where cautious comes in, such that you're never going to get wiped out. Okay? Now, there are flavors of that. That can amount to being partially levered. That can amount to taking $1 and investing 50 cents and holding 50 cents of cash back. All those are variants of the cautious strategy. I'll call the latter one dry powder. So dry powder is literally so unlevered that you're 50 cents in and 50 cents of cash. Okay? The third strategy, even more conservative, is to do nothing, is to raise $1, sit on the entire dollar, and wait around for a fire sale. So here it's a war chest strategy. You're just waiting for somebody else to screw up, and you're going to come in and buy. Okay? So this is the range of possible things that can happen. The only thing I've ruled out, the only substance to the little lemma here, the only thing that you don't do that's never optimal is to borrow so much that you blow up, but not the max. That is to say, it's always going to be true that if you're going to borrow enough to blow yourself up, you might as well go all the way. Okay, and what you can see here is strategies 1 and 3 are corner solutions. Strategy 1 is the spread is so attractive you want it all. Strategy 3 is the fire sale is so extreme you want all of that. You'll give up the time 1 spread and just wait for the fire sale. And strategy 2 is an interior solution. You want a little bit of the spread, but you don't want to have to take all your money out if things go badly. Okay, so that pretty much characterizes the range of things that can happen, and we just want to ask, under what circumstances do people do any of these things? Okay, so basically 1 and 2 are going to be the main strategies. 3 is never going to be a situation where everybody waits, right? It seems 3 is relevant only in kind of a mixed equilibrium where some people are going crazy and other people are catching the fire sale. It obviously can't be an equilibrium for everybody wait for a fire sale if nobody's levered up. Okay? So, but this is kind of the full range of possibility. Okay? And let me just try to describe to you if one of these equilibria were to exist, what it would look like. Okay? So what I'm doing here in this slide is I'm saying, suppose everybody was maximally levered. What would prices look like? Then I'll have to ask, is it part of an equilibrium in capital structure for them to be maximally levered? Okay? So first step is assume they're maximally levered and then check out kind of what happens. Okay? So suppose they're maximally levered. Well, if they're maximally levered, they blow up when things go badly. If they blow up when things go badly, there's no arbitrage dollars left around at time 2 in the bad state, so that's the price. The price is just V offset by the noise shock and no arbitrage response. So that's a crash. That's the price goes as low as it can possibly go. Okay, so I'm saying if there's maximally levered arbs, there's going to be a price crash in the bad state. Fold back, what's the price at time 1? Well, these are rational, forward-looking guys. They say to themselves, well, with probability 1 minus P, everything's going to be good and I'm going to get V. With some probability P, there's going to be a crash. So the price is just the present discounted value of those 2 possibilities, good or crash, discounted at the levered cost of capital. That is to say, you pay a premium of C, but it's spread over L dollars, and so that's why your cost of capital is effectively 1 plus C over L. Okay? So that's what happens if you have levered arbitrageurs. Now, to get some intuition, let's take the limit as C goes very small, as C goes to 0. What happens? The time 2 price is still just the crash price. The time 1 price now converges, that thing in the denominator over there. This thing is going to just converge to 1. So the time 1 price is just going to become V minus P delta 2. Okay? So look what happens in this equilibrium. It's a zero profit condition. These levered arbs earn nothing. What's happening basically? They make a $1 spread 95% of the time, and they lose $20 the other 5%. Right? You make a little spread, and then you get blown up. That's a zero profit state of affairs. So that's consistent with the cost of equity being 0. Okay. But is it an equilibrium in capital structure choice? Is it an equilibrium in capital? It's an equilibrium given the capital structure. But if I let them optimize their capital structure, it can't be. Because if equity was free, somebody ought to deviate and say, oh, I can build a war chest. It's free to build a war chest. Cost of equity is 0. I might as well just take $1, sit, and wait for the low probability fire sale. Okay, so it can't be, as C goes very, very small, we know it can't be an equilibrium for everybody to be maximally levered, because somebody will say, equity's cheap enough, I want to stabilize things. Okay, so on the other hand, we're left with the possibility, and you'll see in a minute, the high likelihood that as C gets a little bit bigger, maybe this will be an equilibrium. Okay, so all you get here is it can't be 1 as C goes to 0. Okay, now let's look at kind of the other kind of polar case, which is suppose instead people are cautious. Okay, when they're cautious, they're investing a little at time 1 and a little at time 2. So they always have some wealth. Here, the returns have to be, since it's an interior situation, it has to be that the return to having an extra $1 at time 1 or an extra $1 at time 2 in expectation has to be equalized. Okay, and that's what gives you these expressions. Okay, so again, here as C goes to 0, what's going to happen? Both time 1 price and the time 2 price will go to the fundamental value. Okay? Because you've got some people effectively holding money for time 1 and some holding money for time 2. As you get enough of that, it's going to push both. Here there's a little bit of money waiting around for the fire sale. Okay? So if this was the equilibrium that everybody played and we let C go to 0, here we'd kind of be in nirvana. Everything would be good. This is kind of, the best case scenario. People are unlevered. If you make equity cheap, prices get completely stabilized. Okay? Can this be an equilibrium? Well, if C is very small, yes. But what's the problem? If C starts to get a little bit bigger, this is kind of the intuition I alluded to before. As C starts to get a little bit bigger, price at time 1 has to be a little bit away from fundamental value. There has to be a spread in equilibrium if capital is costly. But if there's a spread, then you're awful tempted to lever up. Okay? And basically what you can show is, as C gets big enough, you can't sustain this equilibrium because everybody wants to lever up, and this is not too big of a price crash, so people are going to want to lever up, and there's not too much of something to make them be cautious. Okay? So basically, that gives you roughly the intuition of the model. Okay? So here's what happens. If C is very, very low, if equity is essentially no more costly than debt, things work out beautifully. Arbitrageurs are cautious, meaning that they kind of hold off a little bit of money for the bad state of the world. It's a nice, safe capital structure, and in the limit, prices kind of get pushed towards fundamental values. Okay? As C gets for higher values, case 2, they're going to go to the max. They're going to go to the other corner, and you'll get sort of a lot of stabilization at time 1, because they're trying to drive the spread to 0, but if things go wrong, they go very wrong. And then there's a sort of an intermediate case, which is kind of cute in a way, because even though everybody is homogeneous in terms of their cost of equity, different people in equilibrium do different things. So here you have the coexistence. On the one hand, you have some guys who are maxed out on leverage, but C is now not so high that there's not also another group who's kind of playing the waiting strategy. Okay? So here you have the two types living together. Very aggressive guys and some guys who wait around who don't do anything at time 1 and just wait around for the fire sale. Okay? So to show it to you graphically, what I've got here is on the vertical axis is the maximum leverage. So this runs from here 6 to 20. And what I've got on the horizontal axis is the cost of equity scaled. and it runs from 0 to 2%. Okay? And as I said, in the sort of lowest region for equity costs, you have this kind of modest leverage equilibrium. As we go to the right-hand side, we have maximum leverage, and in the middle we have this mixed area where kind of the two strategies coexist. Okay? Now, to get some intuition for what this is all doing, let me do a thought experiment. So this is not yet a policy recommendation. Okay? It's just a thought experiment to give you guys some intuition about how the model works. So what I'm going to do is I'm going to take this machinery. I'm going to suppose the free market will allow you to lever up to L equals 10. And then I'm going to contrast what happens in the free market, free market setting with a case where a regulator comes on and says leverage is forbidden. Okay? And show you what prices look like in the two regimes, and it'll hopefully allow you to see what's going on. Okay? First observation is if equity is very cheap, the law is redundant. Okay? Because if equity is very cheap, people voluntarily choose not to lever. Right? They're cautious on their own. It's just overkill to tell them they don't need to. Okay? You get the same thing. It's irrelevant. Okay? It turns out for intermediate values, this law looks very, very good in this model. Okay? What the law does is it basically eliminates crashes altogether with very little downside. Now, that's not robust in the sense that if you push the cost a little bit higher, now the law is very much of a mixed blessing. It still gets rid of crashes in the bad state of the world, but the price you pay is, since you've made it expensive for people to finance themselves, the spreads stay wide. There's very little. Arbitrage is insufficiently aggressive, and you leave prices far from fundamentals at time 1. So there's a trade-off between time 2 efficiency, if you will, in the crash state, and time 1 efficiency just up front. Okay, and I'll just show you this graphically. So what I've done here is plotted what prices look like as a function of the cost of equity. For both, the red thing is where there's the law against borrowing. The blue thing is where you can borrow up to a leverage ratio of 10 for an example with these parameter values. Okay, so that's the noise shock. As I said, the bad scenario is relatively unlikely. It happens with 5% probability. Okay, so what do you see here? As I said, for very small values of C, you get the same thing. Because in equilibrium, people may be allowed to borrow up to 10, but they don't. Okay? But once the cost of equity gets to 1.25% in this scenario, guys go to max leverage if you let them. Okay? So the blue line shows you get a big price crash. Price drops to 80 in the bad state if you have max leverage, whereas if you make a law against leverage, the price is always kind of stabilized around 95. Okay? This is the law gets rid of fire sales. Okay? Because nobody's levering up. They'd like to lever up, but they're not allowed. Now here's the downside of the law, potentially, is look at prices at time 1. Look at prices at time 1. For a while, they're pretty much the same. In fact, they're identically the same up to a point. Then they start to diverge very slightly. That intermediate region is the region where the law is pretty good, because the law is getting rid of crashes in the bad state, and you're not paying too much of a price in the good state. So again, for C equal to 1.25%, you basically get rid of crashes in the bad state, no negative effect in the good state. But now, if the cost of equity gets really high, 4 or 5%, then getting rid of leverage, it's still helping you not have a crash, but it's really impeding time 1 arbitrage, because it's awful expensive to do the spread trade. So you're going to do less of it if you can't borrow. Okay? So here's a case, again, if you think of this as 3, 4, 5%, it's less clear that the thing is doing you any good. Okay? So that's the basic model. And let me just conclude with a few words about, again, this is pretty speculative, but how might a model of this genre, if not this model itself, how might it inform the way you think about financial regulation, capital regulation more generally? Okay? One thing is, this kind of model is a fairly different perspective. Again, I'm not saying this model says that capital regulation is a good thing for sure. I'm saying it gives you a way of thinking about it. But to the extent it gives you a way of thinking about it, it's a different way of thinking about it than I think we traditionally do. The traditional argument for capital regulation, in banking, starts with the FDIC. says, well, we've got government deposit insurance, and that gives the banks, some incentive to bag the FDIC, and we've got to fix that, and capital regulation is the thing that fixes that. Here, there's none of this. The only people you're borrowing from are rational lenders. They're getting taken care of in equilibrium. You're having to pay them a coupon that compensates for whatever happens in this model. So you're operating on behalf of this coalition. They're taken care of. The problem is not the FDIC problem. Rather, it's this fire sale spillover problem. Okay? So this different perspective, I think, makes you think about capital regulation differently. First of all, if you were going to have capital regulation according to this model, you wouldn't limit it necessarily to FDIC-insured banks. What's relevant here is what are the assets you hold. You would basically want to regulate, if you wanted to regulate anything, you would regulate the capital of anybody who holds the sorts of assets that are subject to these fire sale problems. Okay? So it might suggest, A, a broader scope. It also suggests if you want to do risk-based capital requirements, what's relevant is not the idiosyncratic volatility of the asset that they're holding. It's not the risk of ruin that the asset imposes on the bank itself. It's the spillover issue. Right? So in the limit, if a bank holds a very nasty asset that it's never, ever going to sell, that's not maybe as problematic as it holding an asset that it might sell under duress and that is widely held by a bunch of other leveraged parties. So your measure of what's risk for risk-based capital requirements might be quite different if this was your mindset. Okay? Another thing that this model just points out, as I said, is if you want to always get rid of crashes or phenomena like crashes with capital regulation, sometimes that's not too costly, but in other circumstances, and it's awful sensitive, in other circumstances, it can be quite costly, quite distortionary. So this just raises the question of to what extent do you want to use capital regulation as an ex-ante fix versus, this is a fire sale problem. Do you want to deal with the fire sale problem in some ex-post fashion? So this would be using the government as some form of a market maker of last resort. Okay, or lending to a liquidity provider, something like that. Obviously, this has echoes of TARP 1.0. Again, this model can't inform whether this was a good idea, but I think it frames the question a little bit. Okay. Last thing I wanted to point out, and here's the black box in my model. Right? I just said, well, there's this cost C, is the cost of long-term finance, and everything hinges on this. Right? If it's low enough, things are very good. If it gets a little bit higher, we've got to start worrying about regulation. If it gets higher, even, then regulation is very distortionary, and we should be upset. Well, it makes you think that maybe a good thing for policymakers to think about is opening this black box. In other words, I don't think we understand. I think it seems prima facie obvious that financial institutions really prefer to finance themselves not only with debt, but with short-term debt. They view it as cheaper for some reason. I don't think we have a good understanding of why. Okay? What's the corporate finance, what's the deviation that gives rise to this C? I don't think we understand. I mean, I would just point out that non-financial corporations don't seem to manifest the same intense preference for short-term debt. So there's various stories out there. I think this is something that would be good to understand better, because if you could understand it well enough to operate on the friction a little bit, there's potentially a very big bang for the buck here. You're taking this model literally. If you could lower this C from 1% to 0.5%, a lot of things get a lot better. And again, I conjecture that that's sort of a general effect in models like this, okay? That the cost of capital is very, very important. And again, my sense of banking regulation is that people who think about it have just punted on this question. They understand that people don't want to hold equity capital, and the regulators say, well, I know you don't want to do it, but this is the law, you're going to do it. As opposed to thinking about, are there ways that we could lower the wedge and thereby reduce the distortions inherent in any regulation, as well as maybe the need for regulation in the first place. So again, I think if there's sort of a direction for further thought that comes out of this, I think this might be one of them. Okay, so that's pretty much it. Again, the basic question is life going to get better now that people are smarter? My personal prejudice is to think, maybe, but not at all necessarily. And I think given that, policy may have an important role to play, and not just for those who benefit from FDIC insurance. At the same time, I want to make it very clear that it's very challenging and very difficult to design a policy that kind of strikes the right balance. I sort of imagine a lot of people in this room are going to be thinking about that topic over the next couple of years. Okay? Thank you all very much.